What if you retired right when the world seemed ready to fall apart? Oil prices surging, markets crashing, and headlines screaming war. Would your retirement plan survive? Let's stress test Joe and Kim's plan and see how having the right investment management framework in retirement and risk management approach can turn panic into peace of mind. Let's get right into this video. So imagine that you're retiring just as global headlines explode. Wars breaking out, oil prices are surging, and markets are tumbling. For many new retirees, this is not a hypothetical, it's something that's actually happening. Or, frankly, for anyone who's been retired or will throughout your retirement, it's something that will likely happen at some point in your retirement. The real question isn't always, have you saved enough for retirement? But it's whether your plan can handle the stress that comes along with anyone's retirement and in situations like I've just described. So for this video, meet Joe and Kim. They've saved $2 million for their portfolio. Joe is 60 years old and Kim is 57. They're retiring earlier than maybe your typical retiree because they want to prioritize their lifestyle and making the best use of their healthiest years. So obviously with the difficult market, they are worried about whether their plan will survive. Do they need to reduce their portfolio distributions? Do they need to reduce their income? Do they need to cut back on their travel? Or even worst case scenario, do they actually need to go back to work? Well, instead of reacting to emotionally to whatever might be happening in the world at any given time, having the right risk management approach and investment framework can provide, like I said, a lot of peace of mind for a retiree. So I'm actually going to show you what I do with retirees, how I help them create a retirement investment portfolio and strategy, the process that I frankly use. So please just go ahead and copy this idea, and I think it'll provide you with a really good starting point and framework for how to manage and set up your investment approach as an early retiree, or frankly, just as a retiree in general. I also want to show you some actual information and just teach you what has happened historically when markets have crashed during times of war, oil price spikes, or just bad stock markets, investment markets that have happened for other reasons as well. Because I think understanding historically what has happened can also provide you with a good sense of how to think about whatever particular crisis we might be in at the time. And then next, what I want to show you in this video is go through Joe and Kim's actual example, and we're going to stress test their retirement plan, looking at different historical times when we have faced similar difficult situations like we're facing today. In fact, we can go back to the stagflation years of the 1960s and 70s when there were oil embargoes and the stock market was not doing well to see how using a proper investment strategy and risk management approach can help somebody in a time like this. So I want to show you a very straightforward way to manage your investment portfolio as a retiree. So this is the framework that I use, so please feel free to copy it. Go ahead and use it, make the best use of it. Now, obviously, I don't know all the details of your situation, so today really this is just education about broad principles, but really this is the approach that I do use. So hopefully this can be very helpful to you, whatever kind of situation you are in your retirement timeline. But essentially, my philosophy is that you invest as a retiree based on your cash flows. I call it the ABC approach to retirement income investing. You allocate your investments based on cash flows. Now, what do I mean by that? Essentially, you look at the cash flows, how much money is going to come out of your portfolio from year to year, and that is the driver that tells you how much do I need to have saved in safe investments like short-term government bonds or in money market funds, and how much I can have in a growth portfolio. So the starting point that I do with a retiree is I map out their retirement income plan, and then I look at the first 5 years of retirement and say, how much money, not how much are they spending, but actually how much is going to come out of the portfolio. And with that, I can then just map out and say, okay, we're going to set aside right off the bat 5 years of planned cash flows. So if somebody is spending $100,000 per year out of their portfolio, that would mean $500,000. If somebody's only spending, $50,000 a year out of the portfolio, that would mean $250,000. Pretty straightforward. Now, the remainder of the portfolio is going to be in a well-diversified growth portfolio, and that can be all stocks or mostly stocks. You can kind of go up and down the scale based on your risk tolerance and other factors that I won't necessarily get into in this video. But the idea is you want to set aside and protect your first years of cash flow. Now, when you go from year to year, it's pretty straightforward. So you start year one, you spend down your cash, and then as you look out for the upcoming year, now you have 4 more years worth of cash and high quality bonds ready to use for the next 4 years of income. So you're actually going to look out to that 6th year of retirement, see how much you're going to be spending out of your portfolio in that year, and you're going to set that money aside out of your growth portfolio into your safe, cash and bonds bucket. Now, if the market's been really poor, you've had a negative year in the stock market, you don't have to refill that cash and bond bucket just yet. You can just go ahead and spend your next year of cash and bonds and wait for the market to recover. Once the market recovers, then you can go ahead and refill those cash and bonds. The purpose of this approach is to protect your retirement portfolio in a negative or difficult stock market. So why do I think that this is a good approach? Well, it's all based off of what's happened throughout history with the market. And obviously, just because something's happened throughout history, it doesn't mean that is what will happen going forward. But I don't want to shortchange a historical analysis because we faced lots of situations with extremely difficult markets and ones that always have parallels to the current day. And so I think we can glean a lot of wisdom from looking back at history. So I want to show you some really great charts about how the market has behaved, like I said, during times of war, oil shocks, to give you the numbers and the information behind this particular retirement income investment approach. So this chart gives us a lot of really good information. So first, what is the data we're looking at? The data we're looking at here are times of oil shocks going back to 1990 to the present, and there's actually been several of them. We've had the Gulf War in 1990. We had the second Gulf War in 2003. There were things that happening in Niger back in 2006, disrupting global oil supplies. We had the Arab Spring and the Libyan Civil War. We had sanctions on Iran in 2011. There were drone strikes on major Saudi Arabian oil facilities in 2019. And finally, we had the disruptions to the global oil market that happened in February of 2022 with the invasion of Ukraine by Russia. So actually a pretty good data set. And so what we're looking at in this chart is we're looking at what has happened after an oil shock has happened. And we're looking at from that point in time of the oil shock, looking out on average over different periods of time, what has happened, the price of stocks. So now the dark blue dot, that actually tells us on average between these kind of 6 different events, what was kind of the cumulative average of where the stock market was at these different timeframes after the shock. But then the light blue shaded area for each of these timeframes gives us the range of market returns. So the light blue shows the range of returns and the dark blue dot is showing us what the average return was over those different timeframes. So you can see that 2 days after an oil shock, on average, slightly negative returns. After 2 weeks, still slightly negative. Now, as we go out further in time horizon, this is where, okay, things are looking better. 2 months after that shock, we have an average positive return of 1.4%. After 1 year, on average, a positive return of 12%. And over 2 years from the shock, on average, about a 32% gain in the S&P 500 after these oil shocks. Now, on average as well, that's 32%. But if we actually look at the range of outcomes, there was never actually a negative stock market print 2 years after an oil shock. So the reason I'm sharing this is that, and why this relates to the previous chart about setting aside 3 to 5 years, and I like to just start with 5 years worth of cash, is that you're really protecting yourself, even if there's a very significant shock to the market because of oil issues in the global market. If you set aside that cash and high quality bond buffer, then likely you're putting yourself ample protection to allow stocks to recover before you have to begin selling those stocks. Let's look at a couple more charts. So this chart over here on the right, what this is showing is how the market has recovered, where the market was at 1 year after at least a 15% decline in the S&P 500. And we've got data going all the way back to 1929 with the Great Depression. And so on the left-hand side in light blue, you can see the time frame and how much the market fell. Now in the dark blue is looking out from that point of decline, looking out 12 months from that point, how much had the market recovered over that time frame. So you can see, we'll just point out maybe a few of these. So in September of 1929 through June of 1932, you've got a decline of 86% in the market. That is obviously extreme. And 12 months later after that decline, you had an increase of 137%. Look at a couple more of these. Let's see. You got November of 1968, a decline of 36% with the next 12-month rise of 49%. As you can see going down the line, usually after a very significant drop in the market, up until this point, it's been very, very strong. And this is one of the difficult issues, frankly, of trying to time the market, is that when the market declines, your impulse is, my goodness, I need to sell out of the market and protect myself. But actually, by doing so, you might be, historically speaking, you would be cutting yourself off from the best gains that are possible. On average, after a significant market decline of at least 15%, 1 year later, the market has been up by 52%. So again, this is why it makes sense to have a cash buffer set aside so you can weather that downturn in the market and allow your stock portfolio to recover. And by having 5 years, I think that is a very strong starting point to provide yourself ample time and protection to accomplish that. Now, this final chart that I want to show you is really illustrating something that I think most retirees and investors know intuitively, which is the importance of diversifying with bonds and with stocks, because obviously over time we use stocks, a diversified portfolio, to overcome inflation and allow ourselves to have a inflation adjusted good retirement over time and financial security. So what are the purpose of bonds? Well, I don't know what your experience has been in particular. There's lots of different types of bonds, but this chart I think provides us with some really good information. So what we have here is a comparison of what has happened between bond and stock markets at different levels of market decline. So you can see over here, we'll just start on the right, when there have been market declines of somewhere between 0 and 5%. So we'll look on average here, S&P down 2.4%, bond markets are slightly positive. When equities are down, the stock market's down between 5 to 10%, right? Bond markets they're not necessarily going to be positive, but you can see here, being down just a fraction of that is really providing some capital preservation, some stability to your portfolio. And this is where bonds usually, on average, historically have really shined. You see here, when you have severe stock market declines, greater than 10%, this is where that buoyancy, that capital preservation of high quality government bonds or high quality short-term corporate bonds can really step in and provide some of that capital preservation. So when stocks are down on average greater than 10%, on average, the bond market is up. And you might think, oh goodness, just being up 1.5%, 1.8% in this chart here, not that big of a deal. But again, remember the purpose of these bonds and this 5-year of safe bucket is not to really earn a lot of money or even necessarily keep up with inflation. I mean, if you can earn a couple percent, more power to you, that's great. But the real purpose is capital preservation, stability of your portfolio so you can protect those cash flows and not have to invade your stock portfolio. Give that time to recover. Have I covered this enough already? I think that I have. So now let's look at some historical examples, actually looking at a retiree's case study to give you an idea of what this looks like in practice, looking at a retirement plan through history. So let's pull that up right now. So this retirement plan might look familiar. I've used this in a previous video talking about retiring with a mortgage. Now, Joe and Kim are 60 and 57 years old. They want to retire early, enjoy their life. Here's the deal. They need $10,000 a month to be able to cover their expenses and because they still have a mortgage payment. Now, they're going to have their mortgage paid off within the next 10 years. And after that's paid off, they can go from needing $10,000 a month down to $7,000 a month. Now, they've saved $2 million in their retirement portfolio. And that is a mix of traditional IRA money, Roth IRA money, and some brokerage money. So first, let's look at their cash flows, and then let's jump right into the historical analysis. First, we have their cash flows. Where is money coming from? So this is a year-by-year illustration of their income sources. So here in black, we have they're retiring this year. And you can see that for the first several years of retirement, all of their cash flow is coming from the portfolio. They're particularly worried, and this could be particularly detrimental, going through a very difficult stock market right at the beginning of retirement. And so you can see that after several years of this, once they are older, Social Security for both of them kicks in. So the dark blue here, this is Joe's benefit, and in light blue, this is Kim's benefit. At which point you can see that actually they no longer need to pull money out of their portfolio. Now, in fact, they could if they wanted to, and they haven't run out of money at this point. I'm going to show you that. But what this is really saying is they don't need to. So really, it's all about just protecting them for the first, several years of retirement. Now, when you are pulling money out of your portfolio, you have to have a risk management approach. What is the structure to make sure that you're staying on track? So I already talked about when you start out, you need to have that right investment approach to give yourself that peace of mind and that real world protection. Now, going forward, what is your strategy to manage risk? What I'm showing on the screen now is a guardrail approach. So what this shows us is how you manage risk over time with your portfolio. So here on the left, we're looking at their retirement balance. With the blue dotted line, we have their starting portfolio of $2 million. And then down below, we have a lower number and a higher number. Now, going from the $2 million number over to the right, we have their corresponding monthly income. That number is higher than the $10,000 a month, but this is because this is the gross amount, not the net amount. They need a net $10,000 monthly income at the moment. So this monthly income corresponds with this portfolio value. So when somebody retires and they're seeing choppy markets or really scary headlines, frankly, there's always this concern of, okay, at what point do I need to maybe cut back in my spending or cancel my travel plans or go back to work even? And this gives you that framework to know if you need to make adjustments and by how much. So you can see here on the downside, what if their portfolio dropped by 41%? It goes from $2 million down to $1,179,000. That would mean to keep their plan on track, mapping out everything. Remember, they're really depending on their portfolio just for the first several years of retirement. And then once Social Security kicks in, it's really going to do most of the heavy lifting. So you can see that if they had a significant drop in their portfolio, it would be a good idea for them to cut back their monthly spending by about 3% or $400 in their case. On the flip side, remember, sometimes the markets do better than expected. And if that were to happen, you can see an increase in their portfolio of about 12%. Correspondingly, they could increase their income by about 8% per month. So this already gives us a framework to know, okay, am I staying on track? And at what point, even if we go through a very negative market, do we need to think about adjusting our monthly income? So here's the risk management framework. We have the investments, now we have the guardrail approach. Now let's look at history and see how this has worked over time. So I'm going to come over to this historical retirement stress test. And the scenario that I want to look at is stagflation. So between the late 1960s and early 1980s, I think this is a really good parallel to model out compared to today. There are some similarities. There was high inflation, higher, frankly, than what we're experiencing today, but also, more importantly, significant oil shocks. There was a complete oil embargo that happened. And some of you probably remember when you were young, or you know people, or obviously you've just kind of heard about or read about this, but essentially gasoline rationing, lines at the gas station limited of how much you could fill up. So let's see how their plan, how it would have done over that time frame. So here we can see, let's see, they retired right here in June of 1968. And you can see these green dotted lines that are happening. Now what these are is when they would have, if their portfolio had hit that upper guardrail, they could actually have additional income. So you can see as we go through time, interestingly enough, they would not have needed to reduce their income. You might think, how is that possible? The stock market was really struggling. There was high inflation. How is it that they never had to reduce their income? Well, it's not that their portfolio never went down, but remember, it's by how much. Oftentimes, kind of similar to when you're driving down the road. If you start to drift and you hit those rumble strips, it's not a good idea to jerk the steering wheel to overreact. You could get yourself in trouble. Usually just a slight turn of the wheel, you get yourself back on track, back onto the highway. And that's kind of how it works with this whole guardrail retirement income approach. So as you can see here, it's kind of hard to tell, but if you look at the graph below, you have that blue line, which is their retirement portfolio through time. Above it, you see the green, and below it, you see the red. Now you can see, yes, their portfolio did decline as the market was doing poorly and as they were taking out significant amounts of money out of the portfolio in the first few years. And even though it did go down, it never actually hit that bottom guardrail. So they never actually triggered that event where they needed to reduce their monthly income. Now, obviously, this is not going to be applicable to every single plan or necessarily your plan. This has to do with very specifics about how much they're taking out of their portfolio, their particular needed income, and their Social Security benefits. But modeling out this type of risk management approach, it can provide a lot of peace of mind and confidence to map your retirement scenario against historical difficult timeframes to give you that peace of mind of like, okay, my plan would have worked out during this very difficult situation. All right, I feel fairly confident, or I should say I feel more confident than I did the day before about my plans for retirement. So you can see then their portfolio does go down in value, but then it begins to recover as the market recovers. And this goes out almost 40 years to kind of model out until about 2006, modeling out what a full retirement would have looked like for somebody retiring at that time frame. So you can see from this example and from this risk management structure how even during difficult times, you can have confidence during difficult times if you have the right risk management approach. You have a prudent and responsible investment process to keep you on track. And I think what's most important overall is that before you retire a few years ahead of time, you have mapped out your retirement and you've begun preparing and adjusting your portfolio so that it is ready, your portfolio is ready for when you decide to go ahead and retire. I just want to remind you as well that you can often retire sooner than you think. Your best years are when you're younger, when your health is at its best and you can do the most stuff. So it's always worth looking at your numbers and seeing how realistic retirement might be for you. If you'd like some help going through your plan, running a stress test and a risk analysis to see how well you are doing, go ahead and click the link in the description. I'd be happy to sit down with you for a one-on-one consultation to help you see how ready you are for retirement and help you put together a plan that can stand the test of time. So with that, I really hope you have a great week, and I'll see you in the next video.